Welcome to the Metals 100 interview series here. We are on location at the Vancouver Resource Investment Conference 2024. I'm very glad to have Gwen Preston with me here today in person to share some of her thoughts on the markets. How are you doing, Gwen?
I'm doing well, thanks.
Thanks, good to see you in person again. And maybe just to start off talking about the whole market. I seem to have a feeling that people are a bit worried about potential recessions this year, the first couple of weeks. What's your thoughts on that talk?
Whew, that's the big question, right? I feel like that risk certainly dominated the markets last year, especially in the middle of last year when rates were still rising or there wasn't any confidence in rate cuts. That was the dominant question. Is it going to happen? I don't know. I wish I knew. In the last 6 months, I've become less inclined to believe that we're heading into a recession. I think we might have actually engineered a soft landing, which a year ago I would have just laughed at myself for saying exactly that. But if they do cut rates proactively, while we still have good employment and we still have reasonable growth, it's possible. We've been just chugging along for a while, and as long as we can continue to chug along, that can absolutely happen at this point. The question really then is, when do we get to a point where people are confident about growth? Because investors invest differently when you're positioning for global growth. And that's the change that I'm excited about, because that's what we need for people to get excited about copper, to get excited about, silver, to get excited about growth. That's a different mentality. So I don't think we're going to get there this year, but I hope this year we're going to skate through, demonstrate that the recession maybe isn't going to happen, and position ourselves such that we can look forward to a growth environment.
So let's turn our attention to a few different metals that we want to talk about. The first part is battery metals, because that's sort of a big term in the last few years. We built up a market hype, and investors got a bit of a reality check last year. The lithium price has gone down quite a lot. What's your thoughts on that sector?
Right. So it's a diverse sector to try and comment on as one. Lithium's a good example of it, though, like you say, and it's one of the bigger markets. 2021 and 2022, the lithium price went up 700%. It was crazy, right? And that was because China had great subsidies for electric vehicles, and there was a lot of excitement about that. Did that propel the price too high? Oh yeah, it did. Then when China did not renew those subsidies last year, the lithium market was given a reason to correct from its probably too high number, and boy did it correct, and it crashed right back down. So to me, that's about two things. That's about new markets are prone to overreaction because we just haven't had the history, so there isn't the awareness of what a news event, a demand change, a supply change. There isn't a history to put that in, so it's easier for the market to overreact. Lithium's a bigger market, but it's still brand new, man. 20 years ago, we still only used lithium for ceramics. It was like nothing. So new markets are prone to overreaction. Small markets, when you get into some of the more niche battery metal markets, they're just small. So they will spike and drop on literally a mine opening or a mine shutting down, because that's just how small the market is. So they're risky markets, but the lithium price tanked because China didn't renew its EV subsidies. But you know where Chinese EV sales are right now? They are at all-time highs. So the EV market is continuing. And the United States electric vehicle market is now 5%, which is kind of that tipping point. And the official goal is to get to 50% in the next 6 years, which isn't going to happen. But if that were to happen without Chinese lithium, which is what the subsidies require, you don't get the subsidy for the electric vehicle if it has Chinese lithium, the United States would need to produce 40 times the amount of lithium. 40. So none of that's going to happen, but that shows you the push. That shows you the direction. So those markets are real. Lithium is absolutely in a bottoming process after a crazy roller coaster. There's absolutely opportunity in those markets, but I think they will require investors to be looking to global growth, which brings us back to that first point. We're not quite at a position where investors are positioning for growth.
So let's talk about some other minerals and metals with a more positive recent run. One of them you probably heard a lot in the last few days in your conference here is uranium. So uranium has a really, really strong move last year, especially towards the latter half of the year. And do you think that it will sort of come back to more reasonable level this year? What's your thoughts on that?
I do not think it will come back to more reasonable levels this year. In fact, I would say that current levels are very reasonable. And I know that seems crazy when a price has doubled in 8 months, but the uranium market, the uranium price moved on an absolute lack of supply, of spot market supply. This is 6 years in the making. It was back in 2016 that the uranium producers of the world decided, okay, collectively we need to stop producing so much. There's too much excess supply sloshing around. It took 6 years for the market to work its way through all of that excess supply. It's now gone. The reason the price moved so dramatically, the uranium spot price, there's no speculation built into the uranium spot price. It is literally the average of two-party deals on a particular day. So deals are happening today at $106 per pound because utilities need uranium, and that's the price that they're willing, that's the only price they can get it at. And those utilities still need uranium. I know it seems crazy that they didn't stockpile when it was cheaper, but they didn't. For one, uranium utilities are kind of herd animals. Like if one of them isn't buying, the other one isn't going to buy. There's also a really important east-west divide in the uranium market, which is that the US now consumes 48 million pounds of uranium a year. They produce, in 2022, they produced 9,000 pounds. Like they produce nothing. It's nothing, right? Where did they get it all? They got about half of it from what you'd call friendly countries, Canada and Australia predominantly. They got the other half of it through the port of St. Petersburg. So most of it's from Kazakhstan, some of it's from Russia. That supply is just about to get cut off, whether it's officially because America put sanctions on US uranium or whether it's because Putin says, screw you, I'm going to do it first and put sanctions and disallows exports of uranium from Russia. That's gone. And we're in a market that doesn't have enough supply. And now we're dividing the market in half. And the Western side is even shorter on supply than the Eastern side. There's no easy answer to this problem. America is working to restart domestic uranium production, but that takes time. We're going to get maybe 500,000 pounds of production this year. We might get a few million pounds next year. That's not 48 million. Or is it half of 48 million, which is what they really need to restock? There's no short answer to this. We need big new uranium mines, and it's going to take at least this kind of price and for a sustained period for that to happen. Uranium's been a seller's market, or has been a buyer's market for ages. Buyers have been able to sort of determine the price because there was all this excess. It's a seller's market now. Producers are not going to sell their uranium for cheap because they know how needed it is.
Okay, interesting to hear. So let's talk about gold. Because everybody's all positive about gold, but not so much about gold stocks. So do you see that because we are pretty much at the peak of the interest rate, we're seeing a lot of talks about rate cuts. Mm-hmm. So will that affect the retail money coming back to buy more gold stocks?
So gold performed admirably over the last 3 years, which meant that it stayed sideways. And nobody cares about a sideways price, right? And so fair enough that investors didn't care about gold stocks because the metal itself was just sideways. Now, it's admirable because it stayed sideways even though rates went through the roof. Those things are supposed to be inversely correlated. When the gold price is rising, when interest rates are rising, the gold price is supposed to go down. It didn't go down because central banks are buying gold hand over fist to have it ready for whatever comes in the deglobalization, de-dollarization thing. That central bank buying is still happening. So that fundamental support that kept gold elevated through the rate hike cycle is still there. But now the fundamental shift is that we have rate cuts instead. Not yet. Will it happen in 2 months? Will it happen in 5 months? I'm not sure. But we're heading towards rate cuts. The rate hikes have ended. That's a really significant change. I think gold will have a good year. I don't think it's going to happen until that first rate cut happens. So I don't necessarily think gold is going to break up through 2100 tomorrow, but I think by the time we get to the middle of the year, we're going to be up above there. And if gold can break out of that boring sideways band that it's been in, then I think there is a real chance for investors to start getting interested in gold stocks again. We haven't had that. Like you said, gold stocks are not reflecting the very strong price of gold, but it's just because the price has been boring. And if we can break up and move up because the fundamental premise has changed, we're in rate cuts instead of rate hikes, then there's a chance for it to come back again.
So to wrap this thing up, I'd like to ask for your a very important question that I always ask you at the end of each interview is to provide us with 2 stock picks. Maybe you can give us one for sort of a larger, more blue chip kind of companies, and one on the junior side.
Absolutely. So on the larger side, I'm going to give a uranium company because I am very bullish on uranium. And I think that there's a lot of upside ahead in the uranium market. I think that the uranium price will be higher at the end of this year. And I think uranium stocks have not even incorporated all of the price moves yet. Like, I think there's been a lag in the equities responding. So you want growing US production. That's the thing that is needed. Of course, discovery would be great, but for a bigger, lower risk thing, you want growing US production. And 2 prime examples of that are Encore Energy, which is the ticker is EU, or Uranium Energy, which is UEC. Those are growing US production. They are going to perform well this year, I think. On the junior side, if you're looking for something, the great thing about discoveries is that they can happen no matter what's going on. Like, if there's a great silver discovery tomorrow, a great copper discovery, it doesn't matter what's happening with the silver or copper price, that discovery will get a lot of attention. So if you're looking for a discovery stock in the gold space, one that is underway right now is Founders Metals. Founders. FDR is the ticker. They have a really great discovery that I think is going to get significantly larger than it is. So they're sort of in the discovery growth phase. There's also a stock that will come to trade shortly called Altus that I think is going to do very well. It's sort of undergoing a transaction right now. A private company is taking over a public company called Scorpio. There's a lot to explain in that story, but that's one that I'm very excited about right now.
Thank you, Gwen, for sharing your insights and the stock picks with us here today.
Absolutely. Thanks for having me.
Thank you for your time.